next learning objective is to prepare an income statement and schedule of cost of goods manufactured for a manufacturing company, and then calculate cost per item. So let's introduce some new vocabulary. Cost of goods manufactured. Cost of goods manufactured is the manufacturing cost of the goods that finish the production process in a given accounting period. These costs are determined from activities that took place in the past, hence the name cost of goods manufactured. Notice the word is past tense. Now we will turn our attention to manufacturing companies. A company that sells products needs to set a price for their product. For example, Linda Lou's lemonade stand wants to know how much they should charge for a glass of lemonade. Before they can determine that, they need to know how much it costs to make the lemonade. Linda Lou knows that product cost consists of direct materials, direct labor, and manufacturing overhead. Linda Lou determines that one batch had direct materials that cost $1.50, direct labor that cost $1, and manufacturing overhead, which is her sister, the factory janitor, that costs 50 cents. She adds these costs up and determines it costs $3 to make a batch of lemonade. This is called the cost of goods manufactured. It's the manufacturing costs of the goods, in this case lemonade, that finish the production process. If the batch makes 5 glasses of lemonade, how much did it cost her to make 1 glass of lemonade? Well, $3 divided by 5 glasses equals 60 cents per glass. So Linda needs to charge something above 60 cents per glass. If Linda wants her glass of lemonade to sell for 50% above its cost, how much should the price be? The price should be the cost, 60 cents, plus 50% of the cost, which is another 30 cents. So Linda should charge customers 90 cents per glass. In this lesson, we'll find out how we calculate how much it costs to make a product, so we can later calculate how much to charge for it. Now let's see how costs flow through a manufacturing company. On the left, we have our 3 inventory accounts: raw materials, work in process inventory, and finished goods inventory. Notice all 3 are inventory accounts. Now let's assume the company is a guitar manufacturer. First, they purchase raw materials. These would be raw materials such as wood, glue, and guitar strings. These go into the raw materials inventory account, making the raw materials inventory balance increase. You can think of the raw materials inventory account being the storeroom containing all the raw materials. Then, when materials are used in production, they leave the raw materials inventory account and are transferred into our work in process account, also known as WIP, W-I-P. This WIP inventory account holds all the costs of the guitars in the process of being made. Besides materials, other costs in work in process include direct labor and then manufacturing overhead. Remember, manufacturing overhead are the product costs that cannot easily be traced to a specific guitar. These are costs such as factory rent and factory utilities. Then, when guitars are finished, the costs are transferred from work in process inventory to our finished goods inventory account. These are the guitars that have been finished but not yet sold. Then, when the guitars are sold, the costs are transferred from finished goods inventory to the income statement expense account called cost of goods sold. Notice cost of goods sold is a product cost. Then cost of goods sold is subtracted from sales revenue to get gross profit. Then we subtract our period costs, also known as selling and administrative expenses, and we get our operating income, which is income before taxes and non-operational expenses such as interest expense. So now let's go through this, but this time we're going to use actual numbers and T accounts. Before the company can make any products, it needs to purchase raw materials. So let's bring in a T account for raw materials. And since these inventory accounts are asset accounts, the plus sign is on the debit side and the minus sign is on the right. Now let's talk about examples of raw material. Going back to Linda Lou's lemonade stand, these would include things like sugar and lemons. But let's do a more complicated company, the custom guitar manufacturer. Their raw materials would include wood, guitar strings, and glue. Now, if there were shipping costs for the raw material, sometimes called freight in, then this simply adds to the cost of the raw materials and increases the raw materials account. Let's say the custom guitar shop ordered $1,900 of raw materials and shipping cost $100. The raw materials account would be increased, debited, by $2,000. Notice the shipping cost, the freight in, is just added to the $1,900 to give a total cost of $2,000 for the raw materials inventory. Then let's say $500 of those raw materials was taken out of the storeroom and put into production to start making several guitars. The raw materials inventory account would be lowered by the amount used, which is $500. So where does the $500 of raw materials go? It goes into the work in process inventory account, another asset account. So the $500 of raw materials transfers out to raw materials and into work in process. So the work in process inventory account consists of products that have been started but not yet finished. Then, as the guitars are being built, they accumulate more costs. As you can tell by the diagram, our work in process inventory account contains three types of costs. Raw materials, we already have $500 of materials, and direct labor and manufacturing overhead. So we calculate that the wages of the workers working on the guitars was $4,000. This is classified as direct labor. Then it's determined that $2,100 of manufacturing overhead were incurred building these guitars. These are costs such as a factory supervisor's salary, the factory janitor's salary. These both would be indirect labor. Tools that were broken and had to be replaced. These would be indirect materials. Factory rent, factory utilities, factory insurance, and factory depreciation. Basically all the factory costs that cannot easily be traced to a certain guitar. Now the workers finished some guitars, so we have to transfer them out of work in process to finished goods inventory, another asset account. This account contains finished guitars that have not yet been sold. So let's say we finished several guitars whose accumulated costs of materials, direct labor, and manufacturing overhead totaled $5,800. This is then transferred out of work in process and into finished goods. Then, when some guitars are sold, we remove them from the finished goods inventory, and the cost then becomes the expense called cost of goods sold on our income statement. Let's say we sold several guitars that cost a total of $3,600 to make. Remember, this $3,600 consists of three costs: raw materials, direct labor, and manufacturing overhead. When the guitars are sold, the costs transfer out of finished goods inventory to cost of goods sold, which is the main expense of a manufacturer and appears on the income statement. Now we can determine our ending balances of our inventory accounts. Raw materials has an ending balance of $1,500. We're just doing the math. Work in process has an ending balance of $800. And finished goods has an ending balance of $2,200. Now, if we bring in the company's income statement and balance sheet, we see that the ending balance of raw materials appears on the balance sheet. This means that as of December 31st, the company had $1,500 of raw materials that have not yet been used. Also notice the ending balance of work in process, $800, appears on the balance sheet as an inventory account. This means that guitars that were still in the process of being made had already had $800 of costs associated with them. And also notice that the ending balance of finished goods inventory, $2,200, appears on the balance sheet too. This $2,200 means that there are finished guitars sitting in the display cases that have not yet been sold, and they cost us a total of $2,200 to build. Now let's slide our financial statements over so we can see the income statement part of our diagram. Notice our $3,600 of guitars sold, which is now considered cost of goods sold, appears on our income statement as the manufacturer's largest expense. We subtract that from revenue and we get gross profit. And the period costs, selling and administrative, are subtracted after the gross profit subtotal is calculated. So it's important to understand this diagram. Costs are added to the product as it's made. First, raw materials are ordered. They are transferred to work in process to start building the product. Other costs are added to the cost of the product, like direct labor and manufacturing overhead. Then when the product is finished, it's transferred out of work in process into another balance sheet account called finished goods. When the finished goods are sold, they are transferred out to that inventory account into COGS, an expense on the income statement. So it's really important to understand this flow of costs. So our overall goal is to create the income statement for a manufacturer. And to do that, we need to calculate cost of goods sold. So we will look at the flow of costs through a manufacturer, but this time in more detail. So we know that we start with raw materials. These are the raw materials for our guitar shop that makes custom guitars. To start a guitar, a worker takes raw materials out of raw materials inventory and starts working on building a guitar. These guitars in the process of being made are called work in process inventory. And once a guitar is finished, it's taken out of work in process inventory and added to the finished goods inventory. Now we need to keep track of the costs of these three inventory accounts, so we will need T accounts for each. And we also need to know which side is the plus side and which side is the minus side. Because these inventory accounts are assets, they increase on the debit side. And here are our other two T accounts. This time will also be more realistic. That means our three inventory accounts, raw materials, work in process, and finished goods, start the accounting period with beginning balances in each. So we start the period with $1,000 in our raw materials storeroom, $3,000 of guitars that have already been started but not finished, and $10,000 of finished guitars waiting to be sold. So these balances were the ending balances from the previous period, and they become the beginning balances of this period. So our first task is to figure out how much raw materials we use. To do that, we need to know how many raw materials we purchased. Let's say the guitar shop purchased $9,000 of raw materials. That now gives us $10,000 of raw materials available to use. Does taking the beginning balance of something and adding the additional amount to get the amount available sound familiar? It should. This is the same formula we used earlier to see how much a college student spent over the weekend. If you remember, she started with $10, got paid $90, and this gave her $100 available to spend. She ended the weekend with $20, so we subtract that from the $100 available to get the amount spent. So she must have spent $80. So we will be using this generic formula, which we've seen before, to determine the amount used, the amount transferred out, or the amount sold, depending on the inventory account. So now all we need is the ending balance of raw materials. Let's assume it was $2,000. So it looks like the company had $10,000 of raw materials available and ended the period with only $2,000. So how much must they have used? Well, to go from $10,000 down to $2,000, we have to subtract $8,000. So the raw materials inventory account decreased by $8,000. What would cause this account to decrease? It decreased because we used those materials and transferred them to the workshop, which is our work in process inventory, to start building a guitar. In work in process, the cost of the materials used adds to the $3,000 of cost of the guitars already in the process of being built. So the work in process inventory account holds the product costs. Besides direct materials, remember DM stands for direct materials, what are the other product costs? They are direct labor, abbreviated as DL, which we'll assume was $4,000, and manufacturing overhead, abbreviated as MOH, which we'll assume was $5,000. Now, all we need is the ending balance, which will be given to us in the homework. So direct materials, direct labor, and manufacturing overhead are our additions. Adding the beginning balance in work in process of $3,000 to our direct materials, direct labor, and manufacturing overhead, we get a total of $20,000 of product costs. So if we had $20,000 and the ending balance was $13,000, how much did the account decrease? 20,000 minus 13,000 means $7,000 of costs must have left the account. So why would $7,000 of guitar costs leave the work in process inventory account? Because they were finished and were transferred to the finished goods inventory account. So these $7,000 of costs were the cost to manufacture those guitars that were finished and transferred to finished goods, where they will wait to be sold. The official name of these $7,000 of direct materials, direct labor, and manufacturing overhead that went into making the guitars is called cost of goods manufactured. Notice it's past tense, manufactured. So the definition of cost of goods manufactured is the manufacturing costs of the goods that finished the production process in a given accounting period and were therefore transferred from work in process to finished goods. So it's important to know how we calculated cost of goods manufactured. We took the beginning balance of the guitars that were partially completed at the beginning of the period, added the product costs for that period, this means direct materials, direct labor, and manufacturing overhead, and then subtracted the ending balance of inventory, meaning the unfinished guitars at the end of the period. So again, we just followed our generic formula of beginning balance plus additions, which in this case is direct materials, direct labor, and manufacturing overhead, and then subtracted our ending balance to arrive at the amount transferred out, which was $7,000. Now we are almost ready to calculate cost of goods sold. Before we can do so, we need the ending balance of finished goods, which was $6,000. Now let's calculate the cost of goods available for sale. To do that, we take $10,000 of beginning inventory. These were the finished guitars at the beginning of the period that had not been sold yet, and add the cost of the guitars that were manufactured, which was $7,000. This gives us $17,000 of finished guitars for sale. Now, following our generic formula, if we had $17,000 of finished guitars and we had $6,000 at the end of the period that had not been sold, how much must we have sold? Well, 17,000 minus 6,000 means the account was lowered by $11,000. And what would cause the finished goods inventory account to decrease? Well, we must have sold $11,000 of guitars. That means those guitars cost $11,000 to make. So the $11,000 cost is called cost of goods sold. So that is how we calculate cost of goods manufactured and cost of goods sold. But when we do the calculations on the job, we don't use T accounts on our official paperwork. We can use the T accounts to calculate the numbers, but there's a more formal way to show the math, and that's what we'll work on now. So let's start with raw materials. How did we calculate the cost of direct materials used? We started with beginning inventory of materials, Then we added purchases of raw materials, which increased the account. Remember, freight in is the shipping cost that we pay to get the raw materials to our business. They simply add to the cost of raw materials. We add them both up, and we get direct materials available for use. We then subtracted the ending balance of raw materials inventory, which gave us the $8,000 of used materials. Now let's move on to the next inventory account, work in process. Here, our goal is to calculate the amount of costs that leave the work in process inventory account because some guitars have been finished. We call these costs cost of goods manufactured. We first start with the beginning balance of guitars that were partially built. Then we add direct materials used. But where do we get that number from? We get it from here, our raw materials calculation. Remember, direct materials were removed from the raw materials inventory account and then added to the cost of guitars that are in the process of being built. Then we add direct labor and manufacturing overhead. When we add the beginning inventory to the three product costs, direct materials, direct labor, and manufacturing overhead, this gives us total manufacturing costs to account for. We then subtract ending inventory of work in process, and this gives us the cost of goods manufactured. Now we can work on the finished goods inventory account. The goal here is to calculate the costs that leave the account, representing guitars that are being sold. So these costs are called cost of goods sold. We first need the beginning balance of finished guitars. Remember, these were the finished guitars at the beginning of the period that had not yet been sold. We then bring over the cost of goods manufactured. This is the amount that left the work in process account because some guitars had been finished. They then increase our finished goods inventory account. If we add the beginning inventory of finished guitars to the cost of goods manufactured, which is the cost of the guitars we just finished this period, we get cost of goods available for sale. We then subtract the ending inventory of finished guitars, and that gives us the amount that the account decreased, also called cost of goods sold. So this workflow diagram is really important to understand. You should understand how costs come into raw materials, and then how they flow to the work in process inventory account, and then how they flow to finished goods, and then from there to cost of goods sold on the income statement. Now we'll learn how to create the schedule of costs of goods manufactured. Manufacturers have a formal document called a schedule of cost of goods manufactured. It shows the details of how much the goods cost that were manufactured during that period. To create it, we need data from these two sections. So on the schedule, notice we start with a normal three-line heading. So this is the schedule of cost of goods manufactured for Gabriella's guitar shop. Then we start with beginning work in process, and we add the three product costs, which are direct materials used, direct labor, and manufacturing overhead. The details of the calculation for direct materials used is added in the far left column of the schedule of cost of goods manufactured. As we move down the schedule, notice that total manufacturing overhead was $5,000, which comes from the top of the slide under work in process. But in case the reader of this schedule needs more details, the manufacturing overhead is broken out in further detail in the far left column. We start with indirect materials. These are materials that cannot be easily or economically traced to a certain guitar. Examples include the glue used to glue the wood together. And another example are hand tools that are used to build lots of different guitars. Then we have indirect labor. These are the wages of the plant supervisor who oversees the manufacture of all guitars, and the plant janitor. They indirectly help create the guitars, but we can't directly trace these costs to any particular guitar. Then we have other miscellaneous overhead costs that have to do with the plant. Depreciation on the plant equipment, plant utilities, plant insurance, and plant property taxes. So the product costs total $17,000. Then we add that to the $3,000 of beginning work in process, giving us $20,000 of manufacturing costs to account for. We then subtract our ending inventory of work in process, and we arrive at our $7,000 of cost of goods manufactured. This amount is then transferred to finished goods, where those newly finished guitars are now up for sale. Finally, we'll learn how to create an income statement for a manufacturer. I will show you how this section is used to complete Gabriella's Guitar Shop's income statement. Notice $11,000 of cost of goods sold from our calculation shows up here on the income statement. All that work on the previous few slides was needed to calculate cost of goods sold. Also, the breakout of how cost of goods sold was calculated is shown in the left column of the income statement. This cost of goods sold calculation would only be shown internally. An income statement presented to external users, like the general public, would leave this calculation out. Now remember, cost of goods sold is a product cost. Also remember, the costs of building a product don't become an expense until the product is sold, and the expense is called cost of goods sold. So the costs of building the guitars are kept in one of the inventory accounts until the guitar is sold. Those inventory accounts are raw materials inventory, work in process inventory, and finished goods inventory. Above COGS on the income statement, we have sales revenue, and we subtract sales returns and allowances, and then sales discounts to arrive at net sales revenue. Then, from net sales revenue, we subtract COGS to arrive at gross profit. COGS is listed first because it's usually the largest expense. After that, we list all of our expenses that did not have to do with manufacturing the guitars. This includes office salaries expense, office rent expense, and depreciation expense for the office equipment. They combine for a total of $8,000 of selling and administrative expense. These are also known as period costs. They are costs not associated with manufacturing the product, so they are expensed in the period in which they occurred. Once we subtract the period costs, we get operating income. After that, we add other revenues, such as interest revenue, which this company does not have, and we subtract interest expense, of which this company has $1,000. And then we subtract our income tax expense. And finally, there you have it. Gabriella's Guitar Shop had a profit of $22,100.